Thank you very much, Angus. Good morning, ladies and gentlemen. It's a great pleasure to be back here at the third Scottish Low Carbon Investment Conference, and I think it's a wonderful opportunity to take stock on what has been a pretty eventful year. I was very encouraged to hear the Secretary of State's comments now, and I think I'll pick up on some of those themes, particularly around the certainty and the policy changes which we're going through. I'd also, in these next few minutes, like to take the opportunity to look forward a little bit and to draw out some key themes from the financier's perspective. We've had finance as a recurring theme to the discussions over the past day already, and I think there's a lot to be said here in terms of how do we mobilize capital for the sector. So, looking back for a moment, I think we've had some great progress here in the UK, and I think it's important to just note that for a second. We've had a number of very important milestones recently. We've seen 2.6 gigawatts of offshore installed, over 5 gigawatts of onshore, and we've also seen generation records being set by renewable generation on a fairly regular basis. However, I think it's also inevitable that fragile economies mean that significant challenges remain. Across Europe, capital available to the sector remains constrained. Utilities face balance sheet and credit rating challenges, and bank liquidity, despite some of the very encouraging deals which we've heard about in the last day, does remain quite tight, and I believe unlikely to increase dramatically in the near term. In that context, I very much welcome the establishment of the Green Investment Bank here in Edinburgh, and I'm delighted that we'll hear from Lord Smith very shortly on his thoughts for how we can add a very important new source of liquidity to the capital provision for the sector. Similarly, the hoped-for rush of new equity investors into the sector remains, to a large extent, rather much a hoped-for rather than an actual occurrence. Although, again, I think we have seen over the past year or so some very encouraging signs from a number of new investors new to the sector coming in to provide additional equity investment. Here in the UK, electricity market reform has certainly added to the collective challenge which we face as an industry. Uncertainty has been heightened. Independent generators are increasingly struggling to secure commercial offtake contracts. And as the list of risks grows, there are signs that the risk premium for projects is on the up, and indeed that those return expectations of investors are trending higher to compensate for what they perceive to be higher risks in the sector. Some investors indeed have moved, we hope temporarily, to pursue investments overseas. And I think the supply chain investments that are critical to building out this industry have shown some very encouraging signs, but also, unfortunately, a few notable setbacks with companies deciding to at least pause their investment plans. And I very much hope that that's temporary rather than a longer-term challenge. To try to make sense of all of this, let's step back for a second and look at what are the fundamentals that investors, whether they be banks or whether they be equity investors, look for primarily from this sector. Investors, of course, have a very wide range of requirements and motivations, but I think there are a lot of common features here. Common to that is the need to compare opportunities available on an international scale. This country is competing with the opportunities available in other jurisdictions. And I think also that there is very much a need to compare perceived risk levels in the sector with the returns available to compensate for those. Certainly in that respect, the challenge of explaining new regulatory systems to often skeptical investment committees is a significant one. And I think that makes simplicity and consistency absolutely critical. Regulatory frameworks are a constant concern to investors, and with the recent challenges in various jurisdictions across Europe and indeed on a global basis, the threat of regulatory risk is very high on many people's agenda. Now, RBS has financed over 9 gigawatts of renewable power in a whole host of different countries and under a wide range of different regulatory regimes. One constant requirement for us and for those of the investors whose projects we finance is for the systems that they are financing under to deliver 3 key things: transparency, predictability, and durability. And I was very encouraged to hear the Secretary of State's strong statements about the consistency and the longevity of the projects and the changes to regime which the government intend to bring forward. I believe with these 3 cornerstones, lenders will be able to mobilize the capital needed to fund the sector and its continued development. Data from Infrastructure Journal indicate that over £1.5 billion of funding has already been provided to UK renewable projects in the year to date, principally in wind, but also in solar photovoltaics. However, progress has been rather slower than we would wish, reflecting, I think, caution among developers and a degree of hiatus on electricity market reform. Of course, we've also had to wait some considerable time for decisions on the renewable obligation banding levels. In addition, we've seen increasing difficulty for independent developers, who are, of course, the natural clients for my project finance product, to secure bankable offtake contracts, and I'll return to that shortly. Meanwhile, in addition to funding large-scale renewable generation, we at RBS believe it is increasingly important that banks play our part also to focus on the energy efficiency side of the balance sheet, and particularly to try and drive the carbon reduction and low consumption agenda much more strongly. This is very much still a nascent market. Some areas indeed have very significant need for further regulatory clarity, and I very much hope that that can be done as quickly as possible. But we have been working at RBS quite significantly over recent months on a number of options which we will be bringing forward for our clients shortly. And I'm delighted that one of my colleagues will run this afternoon a panel session to discuss some of the things that we have been looking at, some of the areas we have, and indeed some of the challenges that may lie ahead in that sector. So I'd encourage you, if you have interest on the energy efficiency side, to go along and take part in that, and definitely please join the debate. However, whether we look at the more traditional project finance approach for funding the sector or some more emergent opportunities, lenders remain very much attracted to the low-carbon sector. However, it is clear also from data that the industry is still some considerable way from achieving the velocity of investment which we need. This is a fairly stark chart, I believe. It's Angus and his colleagues at Bloomberg New Energy Finance data showing a pretty significant fall-off over recent years, which I think is due to a number of different factors. Clearly, economic pressures play their part, as do uncertainty in the market. Let's reflect for a moment, if we may, on some of the key drivers here. First off, of course, electricity market reform. I think it's entirely clear and understandable that any major regulatory change will lead to some uncertainty and indeed produce a degree of hiatus. However, I think in addition, many investors have become increasingly concerned by the policy debate around this very complex subject being carried out to some degree in public and on occasion very publicly. What seems on occasion to be an increasing politicization of the sector and of the policy debate has, I think, been extremely unhelpful for investor confidence. We saw that particularly in the very, very public debate within government as to the appropriate level of renewable obligation banding for onshore wind. And I have to say also some recent comments from ministers around areas like Soviet-style subsidies for wind adds into a rather, shall we say, politically charged atmosphere, which I think is not helpful to driving investor confidence. And I'm very encouraged again by the Secretary of State's strong statements on that agenda, because I think it is absolutely critical that government send clear and transparent messages as to commitment to the sector. Critical discussions about a wide range of areas of policy, such as access to market, generation mix, the future role for gas, need to be had, and there are a host of other areas which will also need to be debated. I very much welcome DEC's approach to consultation on many of these matters, and I'm encouraged by the open way in which they have approached that process. However, I mentioned a moment ago in relation to policy direction that clarity and a perception of stability are absolutely critical. I fear we are not quite yet at that point in the EMR journey. I don't want to dwell unduly on the details of EMR. We don't really have time for that. In addition, until the arrival of the energy bill, some of these areas will remain still to be clarified, and we certainly look forward to seeing the detail of the bill in a few weeks' time. I'm very encouraged by recent movements on the payment model, but I think there's still a lot of work to be done under the payment model for CFDs to ensure that those are truly bankable contracts which can bring forward significant investment. I think that the potential for rationing in the allocation of the CFD contracts may well prove to be something of a disincentive to project investment, and thus I think it's absolutely critical to understand the role and the future impact of the levy control framework. More broadly, the potential for rationing contracts for difference may actually perversely lead in some cases to a rise in generators' expectations of return level, given that it will be important for the developers to bring forward their projects, expend significant amounts of development capital without actually knowing whether they will secure a contract or indeed at what price. So I think the efforts that DEC is taking to bring forward some of the early investments, the early indications on CFDs will be absolutely critical to maintaining that velocity of investment. As a bank which has clients across all areas of the sector, thermal as well as renewable, we're watching with very great interest the development of the capacity mechanism and also its potential to impact the generation mix. I believe that at least near term, the contract for difference allocation process will tend to drive a more interventionist role for government than we have seen in the past. And I think it will be very interesting for developers to reflect on that as to how they perceive that risk level compared to the regime which we have seen to date. I mentioned also the challenge of securing market access for our independent generator clients, and I'd like to turn briefly to that now. This is a rather busy chart, and for those of you at the back it may be difficult to see detail, but essentially all you need to know is that the coloured bars each represent one company offering a power sales contract. And as we can see, the volume of companies actually playing in that market has fallen dramatically since 2010. It would appear that the conventional off-takers of power in the sector are reluctant to offer power purchase agreements. I think there are a number of often very understandable reasons for this. There's increasing challenge around aggregation of liabilities onto their balance sheet, but there's also the wider uncertainty of what will the generation mix look like over the coming 5, 10 or 15 years. However, route to market and liquidity issues for independent generators are absolutely critical from the financing perspective. We very much welcome the Secretary of State's call for evidence on market liquidity, and indeed the work that Ofgem has been doing on the same subject. Projects need the ability to sell power and to achieve the CFD reference price, especially for intermittent generators. Independent generators and developers need certainty that they can sell power into the market absent any form of market-wide obligation or a pool arrangement, both of which we've seen in prior regulatory setups. At what price will they access that market? We're still seeing a very significant cost for access to market in terms of the discount received on the power price. And with fewer purchasers offering contracts, that seems, at least in the near term, unlikely to change. Now, I realize this is a low-carbon investment conference, but given recent government announcements, I didn't feel I could speak on this subject without also mentioning gas and its role very briefly. Gas is, I believe, emerging as a very major theme in the government policy debate, and it cannot be ignored. Now, this graph from Reuters shows essentially a fall-off in UK production from the current level to a much reduced level in 2030. UK production here being the orange bar, Norwegian the blue, and other sources the grey. Now, this chart assumes DEC's own assumptions in terms of gas production levels and reserve levels in this country, and also the assumption of essentially flat gas generation levels. To the extent that we see increased use of gas generation, and some of the recent government announcements are quite clearly indicating a preference toward that direction, clearly the impending supply challenges will only become greater. And it seems clear that security of supply concerns, as well as price volatility, will become increasingly significant, as well as potentially driving major changes in the merit order for generation plant in this country. To state the obvious, new build gas may well operate in a variety of different roles, demanding flexibility not only from the machines but also from the contracts which back them up. I'd like now to summarize and try to bring these various threads together. Renewables remain an absolutely key focus sector for the lending community, but we do have a number of headwinds with which to contend. I mentioned macro factors of the broader economy, and indeed we have to take account of the Eurozone risks which exist out there, as well as much reduced liquidity both for developers and for their banks. I am concerned about the perceived politicization of the sector, and certainly the policy environment appears more complex and more difficult for outsiders to understand than when we began the EMR process. We've seen investment volumes fall, partly as those investors able to pursue overseas projects have done so, and partly because of the natural impact of the economy and its broader constraints. It remains very much a fluid and an international sector for both lenders and developers alike. We must remember that most investors in this sector have a range of markets in which they can choose to invest, and it is absolutely critical that we make Scotland and the UK as attractive as possible as an investment destination. With competition for capital, it is critical that the UK embed into new regulation the key principles of transparency, predictability, and durability. I believe that if we can deliver clear messages on these and back them up with binding commitments, then capital will indeed continue to flow into this very important sector. Thank you very much.